Hey, Market Chameleons. Thanks for joining us on the pre-market show. How are you doing this morning, Dima?
Good morning, Will. Good morning, everybody. I guess we had a little bit of a technical issue with the link, so I think we'll put that new link in there.
I tried. Let's hope. Hopefully people can come on. Technology,
Yeah.
it's a great thing, but when it goes bad, it goes real bad. Anyways, let's start with the disclaimer. How about that?
Yep. All right, everyone. Will's going to put up the disclaimer. Keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, contact your registered investment advisor or call your broker. They should be able to help you answer any questions or give you guys guidance. There's the disclaimer, everyone. And with that, I guess we can begin.
Yeah. What's going on this morning?
So I'll take a look at let me share my screen. So one of the things actually, before we even get started, there was an interesting question that came up in the forum yesterday. And the reason I wanted to bring it up is because I've seen people ask this question before through emails and through other chats. And the question went something like this, and we could go to the forum, but the question went something like this where, and this is, by the way, a common question, so don't get nervous, but if I have a spread on, right, and then the spread goes against me, right, and I think this one was particular, it was in Tesla, and let's say the spread goes against me, how do I repair the trade? You know, some people do this with maybe butterflies. How do I repair the trades, or how do I adjust the trade, right? With the assumption that by adjusting it or repairing it, you'll be able to come back to break even or make your money back some way. And this is the psychology. So have people heard this type of question, or and I think there's actually even videos on there like how to repair your vertical spread or your butterfly. And you know, and I think that it's just worth kind of just seeing what other people think, and I'll give you my opinion. But do people think like repairing the trade is the right thing to do? Like, what do they think? You know, taking the legs and adjusting it a bad trade, is that the right thing to do?
Anyone out there on YouTube, let us know what you think about the repairing of a trade. Is that something you like to put into your arsenal, or is it something you do not participate in? You just close out of a trade?
Just interesting to see what other people are thinking, just because I do get this question, you know, and it's been coming, it came up a couple times through emails. I think people even send me videos of how other people are saying this is how you should like repair the trade or adjust your legs if, let's say, the stock is going against you and you start losing money.
We're getting a mixed, with someone saying close out, usually just close out with a 50% drop, close out, take a look and see if there's a new trade first. So those are what we're hearing so far.
Okay, that's interesting. And so this is my view on it, right? And obviously every trader has a different way of managing risk and stuff. But if you do with the initial trade that you do, you did it for a reason, right? And it was a particular outlook. And let's say that whatever you obviously you don't know the outcome until the game is played. When the stock moves, and let's say that trade becomes a bad trade, it's unprofitable. At that very moment, you got to look at it independently from what you did previously, right? So there's no way to repair a trade that went bad. You know, it's not like a flat tire where you ran over. You have a hole in your tire, you patch it up and put the air back in. It's independent. So you have to think of it as, would I be doing this if I didn't incur a loss or did this trade before? So think of it this way. The problem with, like, especially people who first get into trading, not like a lot of experiences, they feel like they have to be right. And sometimes they have to be right and make their money back or break even on the same stock that they lost on, or even on the same strategy. And you got to look at it as independent. The market doesn't care what you had on before, or what you traded, or if you lost or made money. You got to think of it at this moment in time. Everything I have to evaluate it. What is my new outlook? You know, and just think of it as, if I closed out of that trade or never did that trade, because once you repair it or change the legs, what you just did is create a new position. Would you create that position if you never had that trade on in the first place, or if you never incurred that loss? So like this, and the psychology is that you have to be right. And professionals think, how do I make money? Amateurs kind of have that still mentality. I want to be right, and you got to break that mentality. It's not being right. It's about what's best to make money. And think of it this way. If you're playing roulette and you bet on red and you lost, the psychologist, I got to make it back. I'm going to bet on red again, because if I lost some, eventually it's going to come out, but that doesn't change your odds, right? Each spin is independent of what happened prior to that. So you can't, there's no such thing as repairing a bad trade, right? All you're doing is you have to reevaluate and say, at this moment in time, am I doing the right thing? Is this, whatever I do, if I take it off, reestablish a different trade, does that make sense to me? Am I doing it for the right reasons? Are my odds still good? And the important thing from a trade from losses, and this, if you're as a good trader, professional trader, is the important thing is to learn the lesson. What did I miss here? Was there something that I didn't take into account? Was there a lesson that I could learn that could improve my trading going forward? That's important. Not to repair, not because you're not going to trade your way out of a bad trade. You're not going to trade your way out of a mistake. You're not going to trade your way out of something that went wrong. The important thing is to learn, take notes, and make the appropriate adjustments going forward. So hopefully that makes sense. I didn't answer that question in the forum. I just saw it kind of pop up, but I wanted to see people's opinions about it first. Do you ever read? Yeah, Will?
Well, I was going to say the other thing is, all trades should be just a piece of your portfolio, right? A small piece. You're not putting everything into one trade. And no one from the Federal Reserve is watching this show. So we all have limited capital to put to work, right? So you want to put it to work in the best place, right? And if you're just doing something to try to repair something that's already gone against you, rather than close, you're not looking for the best opportunity for your capital. So.
Yeah, exactly. Your job is to always look for where is my best return for the least risk, right? But that's what you're always looking. You're scanning so it doesn't matter if you're wrong, you're still scanning. Where do I put you have limited money and you're not putting everything in one basket, but where am I getting the best return, the highest return for the lowest possible risk? And that's kind of, as a trader, where you're looking around and trying to maximize your profit for lowest risk. Repairing it doesn't really make sense. You guys ever read Jesse Livermore? He was like one of the greatest stock operators.
Lessons of a stock. Was it stock operator or stock broker?
Yeah, and he was one of the first people who actually really started looking at data. And this was before you were able to capture data on computer spreadsheets. He was actually just started to write it down on pieces of paper and study it. And this was back when technical analysis probably worked, right? Because nobody had technical analysis. And he would take all his notes, he would take all his trades, his good trades and bad trades. He'd shut himself in a vault. I think he rented a vault in a bank so he could study and just look, what were the mistakes? What were the things that I did right? What were the mistakes I did wrong? What did I do wrong? Study it. So then he could just improve going forward, right? So you're not going to trade your way out of a mistake, but you should use it as a lesson to learn, what did I miss? What didn't I consider? What should I mark off my checklist the next time I do a similar trade? So hopefully that makes sense to people. Hopefully that's helpful. Of course, traders have different opinions, but that's just my view on it. And you guys could answer that question.
Well, interestingly enough, we had a experience on the floor of the American Stock Exchange, and there was a trader, I won't name names, but he'd lost a bunch of money in a particular product. And this was during the internet speculative boom. So there were lots of places you could have moved on to, looked to trade with different, much better opportunities in the width of the markets, the bid-ask spreads. He stayed in this product where the spreads had narrowed and there were lots of people until he eventually had to leave the floor. He'd lost all his capital. So even professional quote unquote professionals can get lost in the thought of making their money back.
Because you start thinking, I got to make it back in the same stock or using the same strategy, and I'm going to do it and I'm going to force it back. But that doesn't make sense. You kind of have to go start looking again, what lesson, what is my takeaway? What lesson do I have? And where can I find the best opportunities to maximize my profits, minimizing my risk? Remember, maximizing profits, minimizing your risk. You're always looking for that and learning from the lessons. You got to learn from your mistakes. If there's a takeaway, you should learn it and say, this is what I need to check off the next time, I enter something similar. So
we are getting something. We got something from Leonard. I haven't seen Leonard before, but thanks for joining, Leonard. He's saying Tasty Trade analyzes trade management with robust data, and sometimes trade managing is better than folding, he says. So that from
whatever trade management. The only way I know what trade management is to manage your risk. In other words, your deltas, your gamma, your vega, but I don't know of a way of managing out of a loss, right? If a loss is a loss, the market is not going to give it back to you because you reestablish the position. But like I said, if you're putting on a new formula we never heard of,
if you're putting on a new trade, the trade has to make sense, right? It has to have edge. You have to have looked at all the variables, and it's a good trade either way.
Yeah, exactly. If a stock falls and let's say you sold a put, the stock falls, it crashes through. Do you sell another put? Is that the right thing to do? Well, would have you done that if you never had a position? You kind of have to evaluate it independently of what your position was prior to it or what your profit and loss were prior to it. You have to look at it from the eyes of independently. Would I be doing this? Is this a smart thing to do if I didn't have a position on prior to it? So
he does say, this is also from Leonard, and he says, game theory, lots of small wagers allow edge to manifest and limits risks of random bad events.
Exactly. Spreading out your risk. Exactly. It's just spreading out your risk, not wagering very big on anyone. Then what you're doing is kind of diversifying and smoothing out. You're smoothing out your standard deviation of your profits and losses, right? By doing good trades, small trades, spreading them out. What you're doing is smoothing out the variance in your P&L. So hopefully that makes sense to people. But of course, the good thing about trading is people have diverse opinions about how to trade, how to manage. But that's just my takeaway from it. And like I said, we've seen that many times, Will and I, being on the floor of the exchanges where people try to almost take revenge on a stock that they lost on, and that never worked out. Like doubling down or tripling or doing whatever, repairs. There's no such thing as repairs that I know. Once the trade's gone bad, it's gone bad. So having said that, let's just kind of move on to what's going on today in the stock. So right now, let's start out with the pre-market report. See what's moving in the pre-market hours. I think we had another question will come up in the chat before we started, so we'll take a look at that. In the pre-market report, these are stocks that are, actively trading in the pre-market hours, most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to take a really quick look at what's going on in the higher market cap stocks. So 20 billion or more. So we see here 21 stocks are in the percentage gainers, 14 in the decliners, and $20 billion more market cap or higher. I see here Nike, that's up 12.1%. That reported earnings today or yesterday, right? Yesterday after the close, I think.
Yep.
After the close. Then a couple other ones up, but not like that one is like the one that's really stood out. Tesla, I saw that was down as much as 5% in the morning, now down 2.9%. So that's moving around a lot. What is this? GMAB? Let me just take a look real quick. Down 10%. That's a biotech stock. So that's from the high market cap stocks. Let me just take a look really quickly, the unfiltered ones. So I see small market cap stock up 200%, SPI. Let me just take a look what this one does. Solar technology. So that's up 200%. So which one do you want to, well, anybody asking about anyone particular? I could go all the way to the top and take a look at SPI, unless somebody
Anything in
wants
the pre-market you like to look at a gap report, people?
So let's, while people are thinking, let's just take a look at what happened in SPI here. So that stock closed at $1.05. Right now it's trading $3.20. This is the range in the pre-market, 109 to 368, trading 11.8 million shares. That's compared to a float of 8.4 million. So very active relative to that float. Looks like there is some kind of news out there here. So I'll let you guys take a look at it and figure out if this is justified, the move. But I see here the biggest VWAP bar between $2.99, $3.16 on 3.6 million shares. This is what this chart looks like in a pre-market. So we see just kind of went way up to here and settling up here for now. Let's take a look at what it tended to do after big gap move to the upside. We see that in 52-week range, traded as low as 55 cents, as high as $4, trading $3.20 right now. VWAP in the pre-market hours, $2.84. So let's just take a look at its gap up history and what it tended to do after gapping up in the morning. So this is looking in the last 3 years, the 12 largest gap moves to the upside. We see here the dates of the moves here. If there's any press releases, we put a note here. You could hover over it. These are the gap moves for these dates. So we see here the average of the 12 largest gap moves was up 59.5%. We see some here as high as 162%. So that's the high over here, 162%. Here's 137%, but this one definitely is higher than, higher than any of these 12 observations that we have in the last three years. So let's see what it tended to do after the opening. What did this stock tend to do? So from the open to the high, the average move was 29.6%. Let me see, with a high move of 206 over here from the open to the high of the day. From the open to the low, the average move was negative 20%. From the open to the close of the day, it tended to go down more than drift lower, more often than higher. 75% of the time it finished lower, 25% higher. The average of those returns was negative 1.1%, but we see that the volatility from the open to the close of the day, on average, it moved another 26.5%. So that's in absolute terms. So up or down, it moved another 26.5% on average, with a high move of 131.5. So very volatile. This is a low cap stock. You could see, what did we say? It was like $15 million market cap, $8 million float. Very, very volatile, very liquid. So be careful with this. I just put it up there as an example because that one, to look at a historical price return distribution after big opening gap move, but just because that was on the top of the list. Well, do you have any other ones that people wanted to take a look at in the pre-market hours?
No, we just had Mike was asking about DR Horton, DHI, when you get a chance about.
Okay.
Let me see.
Okay. Any specific question on DHI?
He was asking about a possible vertical put spread, if you could screen for a vertical put spread.
Sure. So let's do that now. So DHI, DHI Horton, and we're looking at, let's look at the trade ideas cards, and I'm assuming like a bullish put spread.
Sure.
All right, so here's bullish. So right here, what I did on the trade ideas, I filtered out bull put spreads, and what this is doing is it's going to, now we have all these different screeners that you guys could use. Here's a bull put spread, and you could use your own filters to figure out and filter out the best bullish put spreads. There's a bunch of different filters there. This is scanning our own preset filters that we set to kind of highlight any things that come up to the top just as a starting point. So here are the three different bull put spreads that in DHI that it came up with. So the first one, this one was the best one by theoretical edge and had a 70% historical 70% win rate. So it's looking at the October 23rd expiration, selling the 74 put, buying back the 69 put for $1.27. We think historically, based on historical data, 6 years historical data, it's worth theoretical value of 58 cents. That's its average price over the last 6 years. If you did a similar spread with same days to expiration, similar, same distance of the strike price away from the spot price, that gives you an 18.6% theoretical edge. Historically, if we used $1.27 as the market price, selling it at $1.27, that would have been profitable 82% of the time, meaning that at expiration, 82% of the time, you would have been able to buy it back for less than $1.27, resulting in a profit, right? You sell at $1.27, you buy back for $1, you make 27 cents. So that's what this 82% is, how many times you would have been able to close it out at any profit. It's also looking, let's take a look at the other two. It's got the October 16th expiration, selling the 75.5 put, buying the 72.5 put on October 16th. That's a credit of 108, right? So that's like an at the money one. So selling it for a credit of $1.08, we think theoretically it's worth 83 cents, with giving you a 12.9% theoretical edge with a historical win rate 68%. Here's an out of the money spread, bull put spread. So this one is looking at the October 16th expiration, same expiration. That's selling the 70 put, buying the 65 put for 60 cents. We think theoretically it's worth 15 cents, giving you a 10.3% theoretical edge with a historical win rate of 96%. So let's take maybe, let's just take this one maybe. Let's take this one over here and analyze it further. So we're going to take a look at this bull put spread, selling for $1.27, 58 cents theoretical edge, 18%. That's giving you an 18% edge, 82% win rate. Let's take a look at that on the options chain. So I clicked over. This is going to populate the legs of that spread for us on October 23rd. So here's that spread, selling the 74 put, buying the 69 put, $5 put spread. This is where it closed. So one thing, keep in mind, that midpoint is $1.55. You want to try to get your execution as close to the midpoint as possible. This is a very wide spread. So just take a look at that from the midpoint to the bid, right? From the midpoint to the bid, what is that? Almost 20 cents, 18 cents, something like that's 17 cents. So that's actually, 6, 7, 8% getting into your profits, right? That's the fee to execute. So you always want to pay attention to your execution relative to that midpoint, because the further away you get from the midpoint, it's kind of like that's the fee you're paying to get an immediate execution based on the market fair value at that time. Okay, so that you should keep that in mind. 155. this is what it looks like, the payout diagram at expiration. So you see if the stock just sits here where it is right now, you would make that $1.27. If the stock goes higher, you're making the $1.27. If it goes lower right here, you know, down to the 74 strike, you're still, both these puts are expire worthless. You're still making that $1.27. Of course, if it breaks down, goes lower, you're gonna down to here. This is where you're stopped out for a $373 loss. So you still have, see, you still have cushion from where it is now. If it goes up, you're fine. Stays here, you're fine. Goes down a little bit as long as it stays above 74. Let's take a look at this is the 4-year history. Using 4 years of data, I'm going to the distribution theoretical values. So using 4 years of data, we think it's worth 56 cents with a 85.2% win rate. So that's if you're selling it for $1.27, hopefully you get it for $1.55. That gives you a good theoretical edge. If it's worth 56 cents theoretically using historical data, let's change that data a little bit and see how consistent it is. So that's using 4 years of data. What if we just went to 2 years of data? So using 2 years of data, similar. So even if in the last 2 years, you know, the distribution of returns very similar, but we are getting down to not a lot of observations. Let me just try 1 year of data, see what that does. So 1 year of data, you're in the last year, it must have been a little bit more volatile. So we're still seeing theoretical value of $1.11 with a 66.7% theoretical win rate. But again, this is using six observations because you have 23 days of holding period. Let's do this. I'm going to take it back up to 4 years, 4 years of data, and let's see like what happened. Right now, the 30-day IV is 40.3, which is really, you know, 58th percentile. But what I'm gonna do is the following. Let's tighten up these IVs. So I'm gonna use data that, let's say, starts, you know, so what I'm doing is eliminating the very low IVs, right? So I'm gonna take that up to like, let's say 28, and the very high IV. So I'm gonna take that down to, let's say 50, okay? So I just wanna use, how did this strategy perform when I narrowed down the range? So I took out all the very low IVs. I took out the very high IVs relative to today's IV, and I'm going to rerun that. So based on the last 4 years of data, there's 8 observations here. But when the implied volatility 30 IV was between 28.2 to 50, we take a look at it, the theoretical value of that spread, 63 cents, still 65 cents edge with an 87.5% win rate. So just using historical data mathematically, it looks pretty good. Of course, what do you have to take into account? Anything happening right now on the ground, anything that DHI is involved, anything different from the historical data. Obviously, there's going to be, you know, random news coming out and stuff. So those are always risks, but take those things into account when you're you know, when you're evaluating your risk or any type of model. Well, I guess
quick, we got like 4 minutes. We had a quick Costco earnings, and that's the only reason I'm saying that. I think it comes out in the morning tomorrow.
Okay, what's the symbol?
COST.
COST.
This is going to be a quick
look
one.
at that. So
hey, listen, everyone on YouTube, make sure if you have any questions we don't get to them, there were a bunch out there that are really good. Go to the forum and post them in the forum. Dmitry, or there are a bunch of chameleons who are on it. Someone will get to it, and and
if you got, and it would be cool if other people also answer them just to get other opinions. Sometimes, you know, people have very good, you know, very good insights into some of these questions. Some of these answers are really good. So ask your questions, and people, if you're reading them and have an opinion, give an answer, you know. So let's take a look real quick. Costco. So that's coming out tomorrow after the market close. So this is looking at what the implied move was indicating prior to announcing earnings. That's looking at the front month nearest term straddle. So that's what this blue bar is, the estimated move up or down. So you see here, this starts at 0, estimated move up or down. The red bar is the actual move to the downside. The green bar is the actual move to the upside on these specific dates. So this is what, on average, Cusco overestimated the move 67% of the time. The average of the implied moves was 3.5% versus the actual moves after reporting earnings of 2.9. So the average was about 0.6% differential. So that's comparing the implied move to the actual move if we're using the at the money straddle. Let's take a look at the implied volatility crush. So this is looking at what the implied volatility tended to do after reporting earnings. We're looking at the implied volatility with a 30-day constant maturity. So keep in mind when you're looking at the move, if you're playing the move, you're using the near-term options with the long, because that's mostly gamma, right? The near-term options. As you go out further, your vega goes up more. So people who play calendar spreads will hedge the near-term move and then sell the out-term options to play the implied volatility crush. So on a 30-day constant maturity option, the average on average, the implied volatility was down 21% after reporting earnings. So the day before earnings, the average implied volatility was 26. Day after earnings, on average, the implied volatility was 20.8. 5 days later, interestingly, it ticked up a little bit, on average 21.6. So here's what that looks like in the last 12 quarters. We're kind of over here, so we didn't open up yet. But right now we're at 28.9 on average. At this time, it's 25.3 with a high 40.6, low of 18.5. So this is what it looks like in the last 12 quarters. I think
awesome
we're
job, Dima. That is the start of the day, the trading day. So we got to get going. Everyone, thanks for joining us. Great job. We'll maybe hit on Costco tomorrow because it's after the close as well. Get some more details on that. Anything parting, Dima?
No, everybody. Thanks for watching. Thank you for your questions. If you have more questions, put them in the forum. And if you could answer some of these questions in forum, that would be great too, just to get some people's opinions there. And hope to see you guys tomorrow. Have a great trading day.
Have a safe trading day, everybody.